Are you looking to open an account but not quite sure why you should choose a credit union over a bank?
Let's talk about it.
Both credit unions and banks are federally insured. Credit unions by the National Credit Union Administration, NCUA, and banks by the Federal Deposit Insurance Corporation, FDIC. Both the NCUA and the FDIC are backed by the full faith and credit of the United States government.
But banks are owned by stockholders and are for-profit. So what does that mean? It means that after expenses are paid, profits are returned to the stockholders who have unequal shares of ownership of the bank.
The banks need to make money so the pockets of their stockholders, not their customers, can grow.
They usually make this money through higher fees they charge their customers for products and services. And their customers do not have a say in how the bank is operated.
Credit unions, however, are member-owned and not-for-profit. What's that mean? It means you can act like you own the place. You do. Each member owns one share of the credit union and has an equal voice and voting privileges at annual meetings, regardless of the amount of money they have in their accounts.
This one member, one vote practice helps ensure that credit unions operate in the best interests of everyone involved. Members also get a say in who is elected to the credit union's board of directors, which is made up of volunteers who must be members of the credit union themselves.
The member-elected directors make decisions that are best for the entire membership, and they focus on ways to give back to the member owners of the credit union. Being not-for-profit means that after expenses are paid, profits are returned to credit union members in the form of lower interest rates on loans and higher dividends paid on savings and checking products.
This also allows credit unions to have lower or even no fees on different products and services that you would typically pay more for at a bank. But there's one other important way credit unions and banks are different. Credit unions follow the idea of not for profit, not for charity, but for service.
They are committed to providing the absolute best service they can, and they cooperate with other credit unions and share resources in order to bring convenience and savings to their members. Banks, on the other hand, compete with other banks and prohibit a sharing of resources. Credit unions have a philosophy of people helping people.
Credit unions also recognize that each member has their own unique story, especially when applying for a loan. So credit unions take those individual stories into consideration and try their best to make that loan happen whenever possible.
Plus, in the history of U.S. credit unions, taxpayer funds have never been used to bail out a credit union, while banks have used taxpayer funds on several bank bailouts. Now, that's a big difference in how banks and credit unions treat people and their money.
Now that you know, we'll see you soon.